Okay. So absorption and marginal costing is all about a cost classification that we covered. And the cost classification that we covered, which is relevant here, is the concept of variable cost and fixed costs. The concept of variable cost and fixed costs. That is what we will be talking about in our discussion today. So what is a variable cost? And what is a fixed cost? Who wants to remind us of the definition of variable cost and the fixed cost? Anyone wants to tell us what's the difference between these two costs, variable cost and fixed cost? What is a variable cost? The variable cost is a cost which varies with what?
With production.
With production volumes. With activity. Meaning, if you move from producing one item to 2, 3, 4, 5, what happens? This cost grows proportionately. It's a cost which actually moves with every product that you produce. What are the fixed costs? What are the fixed costs? What's a fixed cost?
It's a cost which does not vary with activity. For example, rent.
Yes.
You find that you increase the productivity, but the rent will be fixed.
Yes. Okay. Which cost is stubborn in business? Which cost is dangerous in business? Which cost creates a risk in business? Even during COVID, it created a lot of, between the two, variable and fixed. Which one do you think creates a risk?
I think it's the fixed cost.
Yes.
I would give an example. What happened during COVID? You find that most of the shops had closed.
Mm-hmm.
It's like the businesses, they couldn't cover their fixed costs.
Mm-hmm.
Yeah.
Yeah. In fact, it creates what we call business risk. Because when there's a slump in activity, fixed cost doesn't understand that the fixed cost is still there. Even when there's a slump in activity, the fixed cost is ever there. Okay. Yeah. Very soon we'll be moving to decision making. That's one area where we'll spend a bit of time, how to make decisions. And you notice that when we'll be talking about decision making, we'll again come back to this issue of fixed and variable cost. Now, having reminded ourselves of this classification called variable and fixed cost, let us now talk about these two techniques. What are these techniques all about? So in costing, there are two approaches that you can follow in preparing a cost. You can either follow a marginal cost approach or an absorption cost approach. In marginal costing, fixed production costs are treated as a what? As a period cost, not as a product cost. And the written off as they are incurred. In absorption costing, fixed production costs are absorbed into cost units and are carried forward in inventory to be charged against sales for the next period. If you have understood this statement, then this topic is basically over for you. In marginal costing, we don't pick a fixed cost. We relate it to a period. We say it's period related. This is a cost which is paid not because you're producing, but because the month has ended. Inventory values using absorption costing are therefore greater than those calculated using marginal costing. In absorption costing, we say, no, wait a minute. We must include all the costs into a product. Marginal costing as a cost accounting system is significantly different from absorption costing. It is an alternative of accounting for costs and profit, which rejects the principles of absorbing fixed overhead into unit costs. So in the marginal costing, we are saying that the cost of producing a unit should include direct material, direct labor, and variable overhead. So as far as we are concerned, this is really the cost that we must focus on. That's what marginal costing is. Absorption costing says no. Absorption costing says no. That's not the correct approach. When it comes to costing, you must include everything. So you have got a direct material cost, direct labor cost, variable overhead, and a portion of fixed overhead. So this is the difference between these two techniques for costing. So this is the difference between these two. Marginal costing, closing inventories are valued. So in marginal costing, which is this approach that we have here, closing inventories are valued at marginal cost of production. Fixed costs are not included in the products, but they are charged as a period cost. The cost of sales does not include the share of fixed overheads. In absorption costing, closing inventories are valued at the full cost. What's the full cost? This is what we have here. Fixed costs are absorbed into units. Cost of sales does include a share of fixed overheads. So these are two costing techniques. So you can either prepare your cost based on one, absorption costing principles or marginal cost principles. The following example will be used to lead you through the various steps in calculating marginal and absorption costing profits, and will highlight the difference between the two techniques. Big Wolf Company manufactures a single product. The details as follows: the selling price, the material, the direct labor, variable overhead. Annual fixed production overheads are budgeted 1.6 million, and the company expects to produce 1280 units each year. Overheads are absorbed on a per unit basis. Actual overheads are 1.6. Budgeted fixed selling costs are 320. Actual sales and production units for the first quarter is given below. There is no opening inventory at the beginning of January. Prepare the statement of profit or loss for the quarter using marginal costing principles, and 2, using absorption cost principles. So this is the question that we can expect on these two, marginal costing and absorption costing. Basically preparing a marginal cost statement or absorption cost statement. Okay. So this is what we're going to do now together. So you get ready with your calculators and also with your exercise books, so that as I key in the answers, you're also busy keying in your own answers. Okay. So let's go people. So let's prepare a statement together. So here's your format. You've got your sales. You've got your opening stock, opening inventory. You've got your production cost. You've got your closing inventory. You've got your cost of sales. You've got your gross profit. Then you've got expenses under or over absorption. If you've got selling expenses, okay. So this format that you are putting here is going to help us a lot. So we're doing an income statement. Using absorption costing. Here we are. So let's go. Sales. What are the sales? 240. 240,000. So 240,000. So we'll leave it like that. 240 multiplied by the selling price. What's the selling price? 180. Okay. Let's come to opening inventory. Is there any opening inventory? There's nothing. Production, how many items have we produced? How many items we produced? 280. You have produced 280 items. 280 items times. Now these are absorption cost statement. So the unit cost in absorption costing include direct labor, direct material, Variable overhead and fixed overhead. Okay. Let's put in the elements. Direct labor. In fact, the standard, let me do the right thing. So direct material is 40. Direct labor is 16. Variable overhead is 10. And fixed overhead. The annual fixed production overhead are 1.6, and the company expects to do 1280 units. So what you do is you go 6 divided by 1280. Okay. So 16 divided by 1280. Okay, annual fixed production overheads are 1.6, and the company expects to produce 1280 units each year. So you take 16 divided by 1280. So that is how you get the overheads to absorb into our products. Okay. So then, with this information, you can now come up with a cost. So the cost per unit is 67.25 under absorption costing. So that's the unit cost. Okay. So you come here now, you're going to multiply this, multiply by 67.25. So let's go 280 multiplied by 67.25. What of closing inventory? Can somebody tell us how many items have remained in stock? Can somebody help us? How many items have remained in our inventory? We have produced 280, we have sold 240. How many items have remained? Hmm?
40.
Okay, so what is our cost of sales? It's that one plus that one less. So let's go. What do we get there? Okay, so that is our cost of sales. That's our cost of sales there. That's our cost of sales. So what is our gross profit? That's the gross profit there. Now, one of the most important items is the under or over absorption. So let's go. We have Overheads actual overheads were 1.6 million for the year. So it means that there was no under over absorption. So we absorbed everything. So the actual overheads were in line with the budget. So there was no under over absorption. So come here, you say there was nothing. Then there are some expenses. What are these expenses? Fixed selling expenses were 320. So you come here, you say the fixed selling expenses were 320. So you come minus 320. Okay. So this gives us a net profit. This gives us a net profit. So our net profit is here. Okay. So this is our absorption cost statement, where production and inventory are valued at full cost. We're now going to prepare an income statement using marginal costing principles so that we can see the difference. So let's observe the difference now with a statement that we're going to produce under marginal costing. So let's go. Okay. Let's start with the unit cost. How will the unit cost look like? The unit cost here, as we have said, we don't include everything. We leave out this. We don't need this. So the unit cost, we just focus on the variable cost, that's all. So when we come here, there's nothing. But when you come to our production now, it will be, when we come to inventory also, this time our inventory will be, we see the difference sign. Here again, let's go. So that's the difference. Costs are valued at what? The marginal cost here. Okay. So then, this is called variable cost of sales only. That's a difference. We don't call it cost of sales. We call it variable cost of sales. And this one is called contribution. Contribution. So what is contribution? Contribution is sales minus variable costs. So what we have now is, this is our contribution. Then from the contribution, we say less the fixed costs. These fixed costs, there is those that come from production and those that are from selling. So from production, we are told that there were 1.6 million for the whole year. So for the quarter, you say 1.6 divided by 4. So it's 400 here. Then the other one is what we already saw earlier on. So this is your net profit. So this is the difference. The difference is that our production is based on variable cost. The fixed costs, we don't put them as part of production, put them as period costs, and they come here. Okay. Now, some of you may say, now the profits are different. This one is recording that, and that one is recording that. Where is the difference coming from? Well, it's because of inventory. So we do a small reconciliation here. We do a small reconciliation where we say profit as per absorption cost. So what's the profit there? The profit is here. Yeah. So the profit, the difference is coming because of the closing inventory. We have carried forward some costs to the future period. So we have carried forward some fixed costs. We have carried forward some fixed costs that are sitting in here. So what we're going to do is, let us deal with those fixed costs. So we are saying we have carried forward some costs. So we need to knock off those costs or those expenses. We need to knock them off. Okay. So how much are those? So you say absorption cost less the fixed costs in the closing inventory. We need to knock them off. So therefore you would add the fixed costs in opening inventory. So what is the fixed cost there? Is 40 multiplied by this cost here. This one, 1.25. 1.25. So we go here, you say 40 by 1.25. Okay. So we need to subtract that. That one, we didn't have anything here. So even here is there. Okay. Let's go. Profit as per marginal cost. Okay, now we need a correction here. There's a small correction needed here. 2880. Let's check the figures. 43,200, that's okay. 280. So 280 multiplied by 66. So I need to correct that one. Okay. All right, so let's go. 26,740. 26,740, 26,400. Okay, so let me just check my figures here. And that one also is 66. Okay. 26,690. All right, so let's check that these are also correct. 26,7.25, 7.25, that's correct. 280 by 66 and 40 by 66. Okay, let's just pick these correctly here. And yeah, that's the minus. Okay, production costs. So that's a 320 there. Okay. Production costs, the 400 written off in full and 320. So let's do that. Okay, 26,640 and margin profit 26,740. Okay, and the where is our closing inventory? 240. Let's just make sure that's okay. 240 and 280. So we've got 40 items. Okay. So 40 items multiply by 1.25, 50. Okay, so let's go. We have that minus that. That's 100. Okay. So that is higher than that by 100. Profit as per absorption cost. Profit as per absorption cost. 26,740. Okay. 26,740. That's where we are. 2690. 2640. 18,830, 18,480. So 280 minus 240. Okay. 26,690. That's the marginal cost, 320. Okay, so let's see, that one is okay. Check that one. 7.25, that's pretty okay. So, where is the other one? 280 by 7.25, 40 by 7.25. So the cost of sales 27,060, 27,060, and absorption there's nothing. 320, 320. Let's check the costs here. The budgeted fixed selling costs are 320. So we have a 320 there, and also you have a 320. Production costs. Production costs. Let's go there. We'll go to 16. Okay, so let's go. Yeah. So 16,400. Okay, so let's check where is the sort 26,700 marginal profit as per absorption cost. So let's see what's the difference between these two. So 2640, 2640 minus 2690 minus 2690. Okay, so the difference is a 50 there. So 320, 400. Okay, so let's see. Cool. So our production. So let's go 1280. 1280 divided by 4, 320. Okay, so let's go, let's come here. Let's put in so under and over absorption. So let's go. In this particular quarter, the absorbed overheads were 280 multiplied by 1.25. So that's how much we absorbed. 280 by 1.25. So this is how much we absorbed here. We produced 280 items. So we absorbed 1.25 per unit. And the actual overheads every quarter was 1600 divided by 4. That gives us 400. Okay. So the absorbed overheads, we absorbed the 350. The actual was 400. So we under absorbed. So our under absorbed was 50. That minus that gives us the 50. So now we're able to reconcile. So here there was an under absorption of a 50. Okay. So I left out an under absorption. So we under absorbed by that amount. So now we are able to reconcile our absorption cost profit has agreed with our marginal cost profit. The item which was not captured was the under absorption. There was an under absorption here. We absorbed less. The actual costs was 400, one absorbed 350. So we had the under recovered. So this under recovery, we have brought it back here. And after bringing it in now, we can see that the profit according to absorption costing, that's the one we put here. The only difference between the two is inventory valuation. In absorption costing, our inventories are high by 1.25. So if you multiply 40 by 1.25, you got the 50. So if you go to absorption cost profit, this one, and we remove the 50, we're able to agree to that figure. So the difference between the two figures is basically the fixed cost that are. Okay, so this is our marginal costing and absorption costing, the two principles. So what I'll do, I'll share this document with you. I'll paste it, share it with you. So I'll share this document with you so that you can have a copy. And what we'll do is, for every topic, whatever worksheet I do, I share it with you so that you also have a copy to go through at your own time. So then, today we have gone up to here, preparing a marginal cost statement and absorption cost statement. Okay. What do? Tomorrow, we're going to take another question. This question here. This is a question from one of the past examinations on how to prepare an income statement under absorption and marginal costing principles. So the question is, prepare a profit statement on absorption costing and marginal costs. Prepare a reconciliation of the difference in profit reported in the profit statement prepared in part B above, just like what I did. I explained the reason for the difference in reported profit under the two methods, and the difference is always because of fixed costs in the inventories. Okay. All right, so this was the resumption of our class after 2 weeks of absence due to the exams. So as we have said, tomorrow, please log back at 14:30, at 2:30 on Saturday, 2:30 on Sunday, please log back. Tomorrow, I'll be looking at this particular question so that you can conclude on income and the marginal costing and absorption costing. On Sunday, we go to absorption to activity-based costing. And also, we start looking at the management accounting. All right, so we'll see you tomorrow. Remember, the time is 14:30. Yeah, I'll share with you the recording and also the worksheet for today.
Thank you.